Hey everybody, Marty Mazzori here, Friday the 30th of August 2024 with your weekly video commentary. I have several things I want to jump around between this evening for you, and I won't take too much time, but I think some important data points to explore. We'll spend a few minutes on the stock charts as well. I'll start with what I've got on the screen in front of you there. This is just from our own internal notes. I talked again, or I wrote again this morning about the negative revisions to the monthly establishment survey, the employment data, 881,000 jobs the revision showed did not actually get created that were originally counted in the monthly estimates. And I just wanted to reiterate, and I thought to do this from a presentation that Hedgeye did this morning about something that I said. So I'm just reiterating it with a chart, and that is that negative revisions are pretty consistent with periods entering into recessions. There's really nothing diabolical about this. Again, as I said last week, it's the same organization that gives you the monthly numbers who actually revises them, and just revised them hugely on an annual basis. So it's just that the data isn't complete when they get it. And in the interest of being truly accurate in the long-term scheme of things, they've got to consider the new data that comes in for the time periods captured and then update that data. Now, what we're looking for is trends. Typically, when do we see negative trends in the revisions? And as I said last week, we tend to see them heading into recessions. Okay, so this is before the great financial crisis. You saw them beginning to go negative, the revisions. A little bit positive during there, and then of course we know that the kind of the bottom fell out here. In here in 2015-16, our economic index got close to going into the red, but it didn't. And some of the employment data no doubt was influencing that number as well. Here we were, massive revisions heading into the, albeit brief, COVID recession. And like I said here, we actually joined the recession coming camp in August of 2019. That's what our indicators told us to do. We saw very high recession risk brewing months before we could spell coronavirus, as I like to say, i.e. recession was likely in 2020. Ironically and truly, COVID allowed for a degree of stimulus, gave political cover, that to that point was utterly unfathomable. Hence the historically brief 2020 recession. Make no mistake, it was set up to be quite a bit worse than what we actually got. So here we are. You can see the trend in revisions leading up to current. It looks like it's getting better. It's actually not. It's about to get way worse, because that massive revision that we learned about this last week won't show up until January of next year. So history, albeit last 20 years or so, give us evidence that that is indeed quite the red flag, and supports our notion that, well, we're not predicting when, but I'll just say that recession risk is too high to get cute right here with your portfolio. I also want to touch on AI. I've talked a lot to clients in review meetings, talked about it here on the blog, how that it feels very much like some history of technological innovation where everybody gets crazy. It becomes a buzzword or a buzz phrase or a buzz acronym, and it seems like a race to see who can spend the most on it without really understanding how they're going to monetize it and make money on it. Salesforce, in their earnings call, I presume their CEO, said that AI is not only his top of mind, but can tell you, because I've met with hundreds of customers this quarter, that is the top of mind of every customer, for every CEO, for every CIO. But I want to tell you before I get into this that I think there's a lot of misconceptions about AI with my customers. I've been out there, very disappointed with the huge amount of money that so many customers have wasted on AI. Now, where he's going is he's saying they're trying to do it themselves and they should have, Salesforce do it for them. Our point is that I don't even know how Salesforce is going to turn this into, in the very near term, enough revenue or significant revenue to justify the money spent on it. I mean, again, a few weeks ago, Google said that in their announcement that, we are spending billions, but we're not making any money, and we may not make any money next year. And in the after hours, I think the stock tanked by like 10%. So I just want to throw that one out there as well. It's a topic that'll be alive, no doubt, for us for a while. The implications for the tech sector are dramatic, particularly for the AI stocks or stock, which is NVIDIA, right? They're making billions, but that won't be long-lived if their customers aren't turning that into profits. And we won't even get into today the lack of moat, in my view, that long-term NVIDIA actually has around its business. So our good friend Peter Bookvar, or I should say our good resource Peter Bookvar, talked about the durable goods release. They were a bit weaker than expected, especially when we include the June downward revisions. But here's my point. In terms of CapEx, just to emphasize what I just said, it's all about AI. That's where the capital expenditures are being applied. And then, at least lastly, for the notes I want to share with you today, I say here, while I believe we're less sanguine about the economy than is Bob Elliott of Unlimited Funds, very sharp macro thinker, I find his analysis to be spot on, i.e. the conditions priced into U.S. equities are virtually untenable in the foreseeable future. And I've included this, I believe, in the written blog this week. These are his statements. U.S. stocks don't have an earnings problem. They have an expectations problem. With expectations of 3% real GDP in second half of 2024, earnings growth to reach 16% year over year by end of 2025, and an AI boom ahead driving 21 times price to earnings multiples, such lofty expectations are a setup for disappointment. Big time, if indeed there's a recession coming. In the short term, growth expectations in the U.S. economy remain very strong through the end of the year. Achieving 2.5% growth over the full year, given roughly 2% prints in 1 and 2Q, requires a 3% growth rate in the second half, which is very strong, right? And again, I've illustrated how you tend to get pretty strong GDP prints right before you head into recession, so we'll see. Earnings expectations are elevated in the medium term as well. This quarter's earnings represented the first meaningful positive earnings growth in a while. But after a brief pause next quarter, earnings are expected to grow rapidly through the end of 2025. With revenue growth expected at roughly 5 to 6% through the end of 25, not too far off of U.S. nominal GDP, getting 15% plus earnings growth is going to require a surge in margins to secular highs, I'd say spectacular highs, by the end of 2025. But it's not just earnings growth expectations over the medium term. U.S. markets are pricing in extraordinary growth over the long term as well, with price to earnings ratios running right now just off of all-time highs. They've illustrated that for you aplenty last few months. The optimists argue that this elevated long-term valuation is often rationalized by making the case that AI is likely to have a revolutionary impact on companies and bring about a totally new wave of productivity growth and investments. Folks, I'm reading a book right now called The Engines of the Markets. They're showing us similar statements back to the days of the canal infrastructure, then the railroads, and all the technology advancements since always are met with phenomenal expectations, phenomenal capital expenditures, and typically a phenomenal disappointment before these things actually come to fruition. And imagine the blood in the streets of the markets when equities are bid up in anticipation of phenomenal new technology. And of course, we only need to go back to the dot-com boom of the late 90s to understand how utterly devastating it can be when the NASDAQ index went down 80%. But as I've noted before, even an AI investment boom and extraordinary productivity isn't close enough to justify this AI optimism pricing. And I'll just leave it there because more of it is just more justification. Suffice to say that Mr. Elliott and us are at least on the same page when it comes to how dangerous this AI hype is for unsuspecting investors. Who knows? Maybe it'll continue to just shoot to the moon. A lot's going to happen to justify these valuations, etc., going forward. Okay, just also from just my chicken scratch here that you can't see, listening to the morning session that we have access to live among BCA's top analysts, and Irene Trunkle, who heads their U.S. equity division, was just kind of sharing her thinking about what she's seeing in the earnings results, estimates, and what companies are actually saying. And it pretty much confirmed the message that we've been expressing the last at least few weeks. And that is the lower end consumer is really suffering. And that's showing up. Like Dollar General was just a disaster in terms of their earnings statement. So it's showing up where lower income consumers are spending money. Now, on the middle income side, you're seeing more sanguine commentary from the companies. But then she mentioned, Target cut prices on 15,000 items. Walmart says their business is resilient, but in her view, people are trading down to Walmart. She says she's even doing some of that herself because she just can't justify paying some of these crazy prices she's seeing on certain things. So, and this makes sense. I mean, we kind of think of Walmart as a recession play when you look at they're where you buy things on the cheap. But then again, of course, when it comes to travel, right, things are looking pretty good. Amex, Visa, MasterCard, particularly on cross-border purchases, people are still traveling internationally. That speaks to the health of the folks who are in that upper income distribution and also have assets, who have stocks and are feeling wealthy these days. However, Disney is seeing a decline in their park attendance. Airbnb did lower their estimates recently, although Uber says business is great. They say they have a higher end customer, but I don't know. She talked about that as well. But she says that all in all, this negative trend that she's seeing in the consumer is continuing, if not accelerating. And she wonders if this isn't all going to just kind of come to an abrupt stop and we're going to see things get pretty ugly in a hurry. The BCA economists / analysts who were bullish all through last year when the rest of us were all concerned about equities and bearish on the economy, they have now turned a complete 180. They are very bearish on the economy, with recession beginning either late this year or early next year. So, of course, time will tell. And with regard to the travel and leisure, I did show you the chart last week that says the searches for planes and hotels, etc., kind of fell off a cliff in July. So we're seeing perhaps the beginning or the early signs that maybe indeed people are going to stop spending so robustly on travel and entertainment in the months to come. Of course, and that would be consistent with our recessionary view. Okay, and I'm gonna finish again with a chart that I haven't shown you in quite some time, but I'll get to that here in a minute that speaks to that. So some of the data that came out this week. Oh, and by the way, our economic index actually improved 2 points, but it's still a negative 36, which says recession risks are too high right here. Personal income rose at a 0.3% clip month on month. Personal expenditures or consumer spending rose 0.5%. Now that's a nice increase month on month. So that speaks to the strength of the economy, right? Well, the savings rate has continued to plummet. So it's down to 2.7, which ironically, remember I said that income had grown by 0.3, spending grew by 0.5, savings ratio dropped by 0.2. People are now definitely spending their savings on everyday items. And when you look at the credit card balances and then the concerning 90-day delinquency rates, they're also hitting those credit cards pretty hard. So these are indeed warning signs about the strength of the economy. So folks, Again, it's not all bad out there. We are not in recession. We got 3% GDP here this last quarter, so that all looks pretty good. Again, I've shown you the chart that says right before recessions, you tend to get that last, kind of last breath thrust in the GDP numbers, et cetera. We'll see. We're open to the idea that Wall Street's got it right and there's a soft landing coming. We just think that's a very, very narrow landing strip, at least at this juncture. Okay, so I'll go ahead and go to the one that I said was last before I go to the stock charts. And that is this, this 30-year chart of the S&P 500. That's the white line, okay? We created our PWA index back here in July of 2017, but then we back tested it at key spots all the way back to 1998. So from this point forward is live. From this point back is just simply back testing. And one thing that we discovered was that right before the tech bubble recession, which was a mild recession but a disastrous event for the stock market, our indicator, within 6 months, 7 months of the actual recession officially beginning, was showing recession. Okay, just a few months before the bottom fell out, worst recession since the Great Depression, our index turned red. And then right in here, it stayed green, got close during the European debt crisis, got down there during the 2015-16 corrective action in their economy, was suspect in there. Again, right here is where we started. We were bullish as can be right through here. 2018, when we got these disruptions, we stayed fully long and told clients, yes, that was an abrupt 20% correction, but within the context of an ongoing expansion and an ongoing bull market. And then lo and behold, August of 2019, when stocks were at all-time high, our index rolled over and we put on an options collar, but we kept the allocation the same. By the time we got to December, we were just long put options. We abandoned the collar and started buying gold and real defensive issues. So we had a really good experience when the rest of the world got utterly creamed during the COVID because we were prepared for a recession. Thing is, as we came out of it, our recession light stayed lit. We expected the classic, 2/3 retracement, and then you're in recession. Then the bear market happens, as it has for 100 years. This was there's one other exception, 1949, where we came out of it. Other than that, this was unique. Of course it was. In retrospect, it was, $10, $11 trillion when you add the monetary and the fiscal together. So yes, our light turned green right in here, and we made money. We'd have done better if we would have stayed as long as we were all through these two phases. But our assessment was that this was very artificially stimulated, and that when this rolls back over, that's when the real recession begins. So there we had our peak to trough 33% decline during 2022, which again, our clients barely felt because we kept those defensive positions on. This is what's really unusual, folks, is our light has been lit ever since right in here, mid to late 2022, right? Now, remember, 2023, Bloomberg Economics and just about every other economist out there, with few exceptions like that one group at BCA, were in that recession camp. And if we had recession, man, oh man, stocks are really, really expensive. So here we are in 2024. Recession did not happen in 2023. And most economists, probably in the interest of their careers, have abandoned that call and said, soft landing. Well, there's absolutely nothing in our analysis that says we need to abandon our kind of protective measures in here, because our recession lamp is still solidly lit with a negative 36. Now, again, that's not, the way I couch it is, it doesn't mean a recession's coming. It just says the risk is very, very high. And at the valuation levels that I've illustrated for you, stocks are way, way, way out of their skis if indeed we have a recession. And what I just talked about earlier was things that have us concerned that help justify, this score. There's a lot that goes into that. There's 46 data points. So clients, in case you're wondering, why I sound this bearish tone, even though we're nicely positive, on the year. It's because of the data and, of course, our experience during bubbles past. Also recall that in here, when I basically said we need to start getting defensive, I said, actually, in many, many videos, do not be surprised if the market doesn't scream higher, because even though the Fed says everything's okay, I know they're seeing the data that we see, and they actually started cutting interest rates in here while they were telling you everything was okay. Well, clearly they knew everything was not okay. And we were actually reading reports from the Fed's several hundred economists, and their economists were very concerned about the go forward. So, they literally jawbone markets to try to keep animal spirits alive, to try to avert or mitigate the depth of a coming potential recession. Okay, so I'll stop kind of the macro or the economic stuff right there and just quickly get to the stock market charts. I'm going to kind of focus on the long term, and allow me to apologize for how insanely busy this looks. So just to maybe make the price chart a little easier on the eyes, not much, but this takes us back to before that brief recession in 2020. I just want to show you what the technicals have looked like. So on the price charts, in the price trends, we had these classic rising wedge patterns, right ahead of every little corrective action in here, and right ahead of this really big drawdown in 2022, and then every single one, big or small, had these patterns going into it. What concerns me here when I look at across this whole 5-year period is that the setup right now looks very much like the period going into 2020. Again, different dynamics in COVID, but we're just talking technicals here. So you notice this goes back. We had a long bearish divergence, and then we had one that I could show right here at this new top. The momentum did not jibe with or acknowledge or certify, for lack of a better term, the top, and certainly on the MACD, and certainly not on the relative strength index. And we're coming off of overbought territory as we were rolling over. But notice here, I was showing you a bullish look on the RSI, and sure enough, we came out of that. And that did have us doing some things in here to take advantage of a pop, of a bounce. And again, we weren't anticipating what we got here. And then, but along the way, right here before this 30+% drawdown, we had a long divergence as we were climbing up here. And then boom, boom, we had these divergences that looked very much like the ones here, and then we got that 30+% drawdown. And then let me just fast forward to where we are right now. We're right at the cusp of new all-time highs, just peaked above it here. Long bearish divergences, shorter term, very dramatic bearish divergences. Notice, like back here, overbought, boom. Overbought, potentially boom. So, it doesn't mean it has to play out this way. If the jobs number is weak next Friday and the market likes that idea, if it's not too weak, because it justifies a 0.5% cut by the Fed, stocks will like that, I would think, right now, the way they've been trading the last couple of weeks. Again, it'll mean the Fed will be more aggressive. Fed being aggressive isn't going to help first half of the recession or so, when earnings start declining, because we're in recession, if indeed that's where we end up. On the NASDAQ 100 ETF, little different setup other than, overbought. This looks a lot like the just before the 2022, and this was, I think it was 40% or something for the NASDAQ. I believe it was more than the S&P. Notice this cluster to overbought positions right here. Huge negative divergence as we just came out and just got to the all-time high. Big bearish divergence there. This isn't a bearish divergence because the price hasn't hit the all-time high yet, but we are coming off of overbought territory. Anyway, folks, here's my point. The technicals are as concerning to us as are the fundamentals. And I have also shown you over the years where the technicals get blown out and do not work. And that's going to require a lot of momentum if indeed we pierce through here. And I'm very open to that idea. As long as the fundamentals, as long as the economic setup still has us concerned about a weakening economy and a consumer stopping spending abruptly, that's what's going to bring this market down, if indeed we're going to get that. Now, if conditions rise to meet valuations, then I'll tell you a whole new story and I'll be as bullish as the next person. Right now, we've got to stay diversified. We have to stay liquid. In our view, we have to stay hedged. And I have to leave you on that because I've taken plenty of your time already. Those of you who've lasted this long, thank you as always for watching and listening. And I will talk to you once again next week. Take care. Bye-bye.